Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at CVNA, or Carvana Company. CVNA is a leading e-commerce platform for buying and selling new and used cars. Here's the barchart.com technical opinion rating for CVNA. The rating is a 100% buy with a strengthening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that CVNA is well above the moving average line, so the monthly trend in CVNA is up. Now we're going to look at a daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since January, so the daily trend in CVNA is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel, or even below the Keltner channel, is fine. CVNA is below the upper Keltner channel line, so CVNA is inside the buy zone. Since the trend is up, we want to buy a call. CVNA has plenty of option chains to choose from. We're going to use the December 20 option chain. Right now, the Dec 20 options have 32 days to expiration. Here's part of the CVNA option chain for December 20. CVNA closed at 241 on Friday. That means any calls on the list from 190 to 240 are in the money. Let's take a look at the profit potential for purchasing the Dec 20 240 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 240 call is 1440 to 1485. We tried to enter near the midpoint, so we'll use 1460 as our buy price. Our call option calculator shows the profit potential for this call based on CVNA price changes at option expiration from flat to a 12.5% increase in price. We can see that if the CVNA stock price is flat at 241 even at option expiration, the 240 call will lose 23.8% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we choose to break even and start profiting. Now let's take a look at buying the 220 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 220 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the CVNA stock price is up 1%, the 220 call will lose 15% of its value. We want that to be break even or better, so the 220 call does not meet our requirements. Let's see if the 190 call works. If CVNA is up 1%, I'm sorry, the bid-ask spread for the 190 call is 52.15 to 54.60. We tried to enter at the midpoint, so we'll use 53.40 as the buy price. The call option calculator shows that, the 190 call works. Sorry, if CVNA is up 1%, the 190 call will make $1. That's better than break even, so the 190 call is the one we'll buy. If CVNA is up 2.5%, the 190 call will make a 6.8% or $363 profit. If CVNA is up 5%, the 190 call will make an 18.1% or $965 profit. If CVNA is up 7.5%, The 190 call will make a 29.4% or $1,568 profit. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the CVNA December 20 200 strike call and sell to open these 2210 strike calls. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 200 call for $42.70 and sell the 210 call for $35.40. $42.70 minus $35.40 equals $7.95. So the entry price or debit cost for the spread is $795. The call option spread analysis calculator picture shows that the spread will make a 25.8% or $205 profit if CVNA declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $3,475 cash credit to a brokerage account. As we said on the previous slide, this reduces the cost of entering the spread to $7.95. Here's a note regarding earnings reports. The next CVNA earnings report is scheduled for Jan 29 to 2025. Okay, let's review the trades one more time. It's been a rough go. Please, sorry about this. Please be patient. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the CVNA 190 strike call for $53.40. We also reviewed a spread. The spread said to buy to open the CVNA 200 strike call and sell to open the D20 CVNA 210 strike call. Let's see, at a debit of $7.95. That's it for this week's Optioneering Workshop. Sorry it was a little tough. Look forward to seeing you again next week. Thank you very much.